Investors and traders, let's get right to it. Election 2024, how stocks perform in election years. As if it wasn't busy enough, 2024 is the year of elections. Over 40% of the world's population economy will hit the polls to elect national leaders. 2024 election, an unprecedented setup on Tuesday, November 5th, 2024. Americans will vote in a national election that will determine the control of Congress and the White House. The election will shape the course of domestic and foreign policies until 2026's congressional midterm elections. With the 2024 election nearly a year away, the politics dynamics will remain fluid, with two major parties still to elect their respective presidential and congressional nominees and flesh out their major policy agenda proposals. Right now, it looks like another Biden versus Trump standoff, at least according to prediction markets, favorable polls, and most political pundits. That said, 10 months in a long time in politics. Much could change, and a lead up to election day can stir up emotion and apprehension about the future. There is a common rumor that Joe Biden will not see election day and will be replaced by Michelle Obama or Hillary Clinton or somebody else. But let's get into facts. Historically, U.S. markets have generally risen in election years. Since 1950, U.S. stocks have surged returns of 9.1% in election years, thus saying that in year one of post-election, it is usually up 8.3%. Year two pre-midterm is up usually 3.4%. Year three post-midterm, which was last year, 14.7%. And this year, on average, we are up 9.1%. The minimum down in those years is negative 40% and up 35%, but the average is 9.1%. Of course, it's important to bear in mind that U.S. stocks have historically risen over the long term, so it's not surprising to see an upward trend in the data. Looking at the historical data, it appears that while 12 months preceding a presidential election have the widest range of possible market outcomes relative to other parts of election cycle, the average return isn't substantially better or worse. This points to presidential cycle. Some investors or voters may wonder if this upward trend is due to the party in power trying to juice the economy and markets right before an election. There is also down-ballot races may be highly consequential. Perhaps just as important as the presidential race in November are the congressional races where control of the House and Senate is up for grabs. There are slim margins in both bodies of Congress, and both parties face a number of key retirements this year. While both the House and Senate could be competitive this year, that ticket splitting, such as when voters choose a presidential candidate for one party but a Senate candidate from another, has become increasingly rare, which could impact outcomes. Those down ballot races will determine whether the next 2 years are spent under divided or unified government and will likely impact how much its agenda the next administration is able to accomplish. Expect that in a scenario, unified Republican priorities might include extending the tax changes stemming from the 2017 Tax Cuts and Job Act, which will otherwise expire at the end of 2025, and rolling back provisions of 2022 Inflation Reduction Act. Under a unified Democratic control, there might be a resurfacing of the provisions and priorities, including the Build Back Better plan. And under divided government, there may be continuation of gridlock, with the next administration relying primarily on regulation rather than on new laws in attempting to execute its agenda. Betting on specific policy or sector impacts. When it's possible to anticipate potential policy impacts at a very high level, the reality is that at this stage, no one can predict with any certainty which party will win with certain institutions, let alone what sectors, industries, or stocks may benefit from the next administration policy. But it clearly shows in election years since 1976, energy, communication services, and financials have done much better in this year and outperforming many other industries. We will be looking further into these three, energy, communications, and financials, to see if this year will also benefit from the election year. There are dramatic differences between the proposals expressed on the campaign trail and the actual policy changes that take place once the candidate is in office. It's exceedingly rare that a candidate will be able to deliver on exactly what they propose once they take office. If you're making the investment decision decision based on such proposals that could be a risky way of managing one's money. Next, markets are non-partisan. Although popular myths sometimes suggest that one party or the other party is better for market returns, the historical data does not bear out those theories. The S&P 500 has historically averaged positive returns under nearly every combination, as the chart below shows. In fact, there's some evidence that divided government has historically correlated with stronger market returns, perhaps because government gridlock creates less policy uncertainty. When there is certainty in the market, who will win this election, Democrat or Republican, the market will go up higher. It shows when we have a divided president with Congress and Senate, we have better returns than just having one party in office. People say markets will crash if so-and-so candidate wins. Reality, we've seen some booms and busts on both sides of the aisle. The economic backdrop tends to matter more. While stocks tend to rally in election aftermath, it's true that some election years have seen bigger swings than others, but those instances have tended to be more with underlying macroeconomic backdrops than the election itself. For instance, in the last presidential election in 2022, it was the tides of lockdown and reopening from the COVID-19 pandemic that impacted broad markets most, rather than differing ideologies between the now President Biden and the President Trump, or consider 2008 when Democrat Barack Obama ran against Republican Kane. The unfolding global financial crisis was predominant driver rather than the opposing candidate views on war in Iraq and healthcare policy. With that and the last 40 years of elections in hand, stocks have still been wider and higher a year later on average. Election jitters. Markets tend to rally as the uncertainty fades. The more clearer who will be the president of the United States, the more we will see this market go up higher. The power of the 4-year election cycle is evident in the performance of the current cycle. Let's delve into the presidential cycle with a focus on fewer trades. The presidential election cycle comprises recurring seasonal patterns in the stock market. Discovered by Yale Hirsch in 1986, the best 6 months has been fundamental aspect of our videos and investment system. By combining the 4-year election cycle with the best 6 months of the year and incorporating a MACD indicator, we've constructed a systematic approach with only a few trades but the potential for substantial income. We've traced back to 1949, encompassing the full 4-year cycle starting from the post-election year 1949. Only 4 trades every 4 years are required to triple the results of the best 6 months, buying and selling during the post-election and midterm years, then holding from the midterm MACD seasonal buy signals, usually after October 1st until the pre-election MACD signal, sometimes after April 1st, yields solid returns with less effort, lower transaction fees, and fewer taxable events. Let's break down the strategy visually with just 4 trades every 4 years. The approach is straightforward. 4 trades every 4 years. If we look at the year post-election, the worst 6 months are May to October, we sell. The best 6 months are November to April, we buy. In the midterm election year, the worst 6 months, May to October, we sell. The best 6 months, November to April, we buy. In pre-election year, we hold on to our buys. In election year, which we are right now, we hold on to our buys. Remember the presidential election cycle, combining it with a MACD. This systematic approach, guided by the 4-year election cycle, the best 6-month strategy, and MACD strategy, aims to maximize returns while minimizing efforts, transaction fees, and taxable events. It's a clear and structured method for navigating the stock market across different phases of the election cycle. In conclusion, the presidential election cycle theory posts a cyclical pattern in a stock market performance corresponding to presidential terms. It indicates the first year of a term tends to see the weakest performance, followed by a recovery and a peak in the final 2 years of the term. Understanding and navigating this cycle can be a valuable tool for investors looking to optimize their strategies based on historical market trends linked to the U.S. presidential election cycle. As you know, last year we went fully bullish. We are keeping our stance this year as fully bullish, but specifically looking at NVIDIA, artificial intelligence companies, semiconductors. You know the catchphrase: study it, analyze it, adapt it. Peace.